Welcome to Simple Mind Space. Today, we're talking about how to succeed in the stock market. The stock market can be a great way to build wealth over time, but it's also important to understand the risks involved before investing your hard-earned money. In recent times, we've seen a huge surge of new investors entering the market. In part, this has been driven by news reports of record-breaking market highs, and some new investors are looking to capitalize on this, seeking to achieve fast riches. It's exciting to see so many people getting interested in investing and taking control of their financial futures. However, there is a sad reality to this influx of new investors. Many of them enter the market with a very distorted view of how it works. They see others making money around them and try to emulate their behavior, hoping for a similar result. This can be a very risky approach, especially for beginners who may not have the experience or knowledge to make informed decisions. As a result, a large percentage of these investors end up losing money, or worse, being taken advantage of by others and ultimately being the ones who are hurt. In this episode, I want to share some hard-won insights and experiences I've picked up over the years to try and demystify the stock market and help you approach investing with the right mindset. I'll be drawing on my own practical experience with examples from my time in the Australian and American markets. The aim of this episode is not to give you concrete step-by-step instructions on which stocks to buy and when to trade. Think of it more as a conversation starter. I want to open your mind to the fundamental principles of investing, help you develop a solid investment mindset, and from there you can do your own research and make your own informed decisions. It's essential to remember that investing requires continuous learning and adaptation. Let's get started. The very first thing, and arguably the most important thing, when it comes to stock market investing, is to ditch the get-rich-quick mentality right from the start. We've all heard stories about people investing and seeing their money double or triple in the space of weeks or months. But these stories, for the most part, are either fabricated by con artists or, in a small number of cases, are just pure luck. If you hear people telling you about how they made fast returns from the market, 90% of the time, they are trying to scam you. The other 10% are probably people who gambled and got lucky. Either way, they are not investors. If you're entering the stock market hoping to make a quick fortune, you're already starting off with a mindset that's going to set you up for failure. Even if you do see some short-term gains, in the long term, this approach is likely to come back and bite you. I've been fortunate enough to meet and work with some very experienced investors in both the Australian and American markets, and every one of them emphasized the same thing. Long-term investing and focusing on the intrinsic value of companies are the safest and most effective way to succeed in the stock market. The legendary investor Warren Buffett has a famous quote on this topic, which perfectly captures the long-term mindset of successful investors. If you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. If I had to pick the single most important mindset principle in investing, it would be this one. If you can't commit to this long-term view, don't bother getting involved in stock market investing. Trying to make a quick buck by jumping in and out of investments, chasing short-term profits, or listening to random people's tips is a surefire recipe for disaster. My advice, from the bottom of my heart, is to stay away from stock market investing entirely if you can't let go of this short-term mentality. It's almost guaranteed that sooner or later, it will lead to a bad outcome for you. This, then, is the essential first step. Once you've embraced a long-term investment strategy, we can move on to the next phase, building a watch list of potential companies to invest in. There are so many companies listed on the stock exchange, covering every imaginable industry and sector. It can be daunting to know where to even begin when it comes to picking potential investments. So how do we identify which companies have long-term potential? Which companies are more likely to succeed and which are heading for bankruptcy? These are obviously not easy questions to answer. There are no guarantees in the stock market, but seeking to answer these questions is more productive than trying to predict which stock is going to go up or down tomorrow. In my previous talks on investing, I've spoken about how I spend a significant amount of time researching and analyzing a company before considering an investment. This often takes months, sometimes even years before I'm ready to pull the trigger. I'm sure some of you are wondering why I spend so much time on this process. In response, I always jokingly say that when I invest in a company, I want to know so much about it that I even know what the CEO's neighbor eats for breakfast. Of course, I don't actually need to know that much about a company to make an investment, but I do want to stress the importance of deep, thorough research. I do my best to analyze a company from the inside out and the outside in. Within the scope of this short discussion, however, I'm going to distill my approach down to 4 key areas that I focus on. First and foremost, you need to have a crystal clear understanding of the company's business model. At a bare minimum, you should understand what products or services they offer and who their customers are. Ideally, though, you should go deeper and understand how the company actually operates, their strategies for generating revenue and profits, and whether their approach is sustainable in the long term. To make this more concrete, let's take Apple as an example. One of Apple's key competitive advantages is that they produce both the hardware and the software for their products. This is something that is very difficult for other companies to replicate, as it requires a tremendous amount of expertise in multiple fields. To give a different example, let's imagine that you're looking at an investment in an accounting firm. You should, of course, understand what services they offer and who their customer base is. However, you'll be at a major advantage if you have specialist knowledge in the field of accounting, as it will allow you to analyze their business model on a much deeper level and identify any strengths or weaknesses that an outside observer might miss. Second, flowing on from this understanding of the business model is the question of competitive advantage. Businesses operate in a competitive landscape. Every company faces competition from other companies offering similar products or services. So you need to identify what, if anything, gives the company you're considering an edge over its rivals. Are there any features of their business that make it particularly difficult for competitors to challenge them? This is what's referred to as a moat, a metaphorical barrier that protects the company's profitability. Do they have a strong moat, or can they easily be undercut by a competitor offering a similar product or service at a lower price? To give an example, with Apple, in recent years, they have extended their business model even further, producing their own microchips, in addition to both hardware and software. This is a very difficult thing for other companies to do, as it requires a huge amount of resources and expertise in both software, hardware, and chip design. This gives Apple a huge competitive advantage that makes it very difficult for other companies to compete with. They have built a wide moat to protect their profitability. Now, consider a different example. Maybe you're looking at an investment in a taxi company. They offer a service that's easy to understand, but they don't really have a strong competitive advantage. They are very vulnerable to competition. Any company could come along offering a similar service at a cheaper price. This happened with the rise of ride-sharing services like Uber and Lyft. The taxi industry didn't really have a strong moat to protect their profits, so they were quickly undercut by the new competition. Third, look carefully at the company's leadership team. After all, it is the leadership team that will be using your money to drive the company's performance and growth. You need a leadership team that is both competent and trustworthy. It's important to look at the CEO's track record, experience in the industry, and reputation for ethical behavior. Of course, it's also important to look at the performance and ethical track record of the entire leadership team, but the CEO is a good place to start. After all, these are the people who are ultimately responsible for managing your investment dollars. We want a skilled and trustworthy team looking after our money. On top of researching the technical capabilities and track record of a CEO, I also try to get a read on their character and values. There are several different ways to do this: by reading interviews, listening to talks and presentations, or reading articles and books that they've written. You can gain a sense of their ethical compass and decision-making style. It's not always easy to get this information, but it's worth trying to dig a little deeper, especially when you're entrusting your hard-earned savings to them. Lastly, we come to the question of valuation. After answering the first 3 questions, we'll have a sense of the true value of a company. We need to compare this to the price that the company is being traded at on the stock market. Does the current price accurately reflect the company's true value, or is the company overvalued or undervalued? To make this a little bit clearer, let me give you an example. Once we've completed our thorough research and analysis, let's say that we determine that company X is worth $10 per share. We then check the stock market and discover that company X is being traded at $8 per share. This means that company X is being undervalued by the market. It's like discovering a $10 bill on the street for sale for $8. Obviously, we want to buy it. The stock market doesn't always reflect the intrinsic value of a company, and sometimes it can be significantly off. This happens because the market is driven by emotions, by fear and greed. When people get greedy, they tend to overpay for things. When people get fearful, they tend to undersell. We can use this to our advantage as investors. This is why we need to do our research upfront to understand the true value of a company, so that we can identify these situations when the market price is distorted. To recap, we've looked at 4 key questions for analyzing potential stock market investments. What is the company's business model? Does the company have a strong competitive advantage or moat? Is the company's leadership team competent and trustworthy? Is the company currently undervalued? It's impossible to cover all the complexities of stock market analysis in a short podcast like this. What I've given you is just a very basic overview. I hope it can serve as a starting point to help you begin to get a sense of how to approach stock market research and identify companies with long-term investment potential. Keep in mind that this is not a comprehensive course, so remember to do your own research and seek out other resources to continue learning and refining your investment skills. As a final point, I'd like to address a question that has come up a few times recently from listeners regarding my online investment course, which is currently coming to an end. Several of you have asked if it's still possible to join the course. I appreciate the interest. Right now, I don't have any immediate plans to run another course, but I will make an announcement on my website when this changes. So if you're interested, stay tuned. Thank you for listening. If you enjoyed this episode, please like, share, and subscribe to our podcast for more insightful content on personal finance, investing, and life skills. Have a great weekend, and see you next time.